Offset bank accounts, they're super popular. They offer borrowers the opportunity to reduce interest payments on their loans by allowing them to offset their savings against their outstanding debt. To me, that sounds very advantageous for those with a mortgage, absolutely worth utilizing without a doubt, mainly because of the value of having convenient access to those funds without them actually being consumed by a loan. However, I recently came across an idea that has a bit of merit to it, in my opinion anyway, where banks introduced this type of account to encourage borrowers to keep their loans open for longer, thereby benefiting from extended interest payments. When you take a step back and really look at it from a bigger point of view, the banks are probably the ones who are going to be benefiting most from this pretty fantastic tool that is offered to many people these days with their loans. They offer a product that allows you to have liquid access to your cash when you need it, and it also allows you to reduce interest paid on a loan if you optimize and use it wisely. Lots of people do not, and therefore today I'm going to tell you why I think banks are very, very clever in this realm, where it makes them look like they're the good guys here offering you something, but they're the ones benefiting most from it. In this video, I'm going to explain how offset bank accounts are aimed to prolong a loan for a bank so they can maximize the amount of money they can make off of an individual when they decide to borrow money from them. Let's get started with a recap. Offset bank accounts are a special type of account that can help you save money on your loan, like a mortgage. Here's how it works. The money you have sitting in an offset bank account is taken into consideration when calculating the interest you owe every single time you have to make a payment on that loan. So let's say you have a loan of $100,000. Let's say you have $10,000 in your offset bank account. Simply put, instead of paying interest on $100,000, you'll pay interest on $90,000. And the kicker is that you can withdraw that $10,000 at any period of time. Whenever you see fit, that money is liquid in a bank account that you can use freely. It's like having the best of both worlds: easy access to your money and savings on interest payments. The key point here is that the principal amount of the loan, so the outstanding debt you have, will snowball. It will pay down faster over and over and over because you're paying less interest over the life of the loan. Again, I'm going to continue saying this throughout the video for those that optimize and really stick to the benefit of an offset bank account. The win or payoff from doing this is that over the life of a loan, individuals will save thousands, tens of thousands, and potentially even hundreds of thousands of dollars, depending on how quickly they can build up those offset accounts. Having liquid access to your funds as well offers many benefits, the most important being that you can build up a safety net for unexpected expenses, and potentially for those who are wise with their money, they can utilize the built savings in an offset account for other ventures if there is a better opportunity to utilize their money elsewhere. So with the recap out of the way, let's touch on the clever part as to why banks would offer such a amazing product to its consumers. The idea that offset bank accounts are designed to encourage borrowers to extend or prolong the life of their loan stems from a misconception of how these accounts function. Having access to your funds through an offset bank account does not inherently promote the extension of a loan. Instead, it empowers borrowers to manage their finances more efficiently and more effectively, or more inefficiently and more ineffectively. Think about it from this perspective. When borrowers have access to their savings, they can use them however they see fit. We all know that when emotions come into play, people's ability to think logically and their reasoning often becomes clouded, potentially leading them to make poor decisions, deviating from their original plan. Or they might make choices that can have long-term repercussions on their debt. If you're interested in learning more about behavioral finance, I suggest you go and watch this video on the topic I made a while ago. I've linked it down in the description below. I think it's quite interesting and I think it's a good fit for what I'm talking about today. Anyway, while I consider myself to be quite disciplined, especially with my finances, if you were to ask me over the past 30 years of my life how many times I gave into impulse buying or made poor decisions with how I manage my finances, I'm sure the tally would add up to be higher than I would like to admit. From the perspective of lending institutions, as in banks, offset accounts offer a competitive advantage by attracting borrowers and encouraging customer loyalty. Banks obviously want your business, so it's going to be in their best interest to be as competitive as possible. So offering products like this, it's only going to be a win for them. But here's the thing, they benefit plenty from the existence of this type of account. As of 2022, the Australian bank liquid reserves to banks assets ratio was sitting somewhere between 10 and 15%. This requirement is in place to ensure that banks have enough funds on hand or available to handle any unexpected situations, as well as meet their financial obligations. So, by storing your savings in an offset bank account, you inadvertently enable banks to lend out larger amounts of money to a larger audience of borrowers, therefore increasing their profitability. From the bank's perspective, it's a highly advantageous concept because it almost guarantees that you will be channeling funds towards your loan for an extended period of time, potentially up to several decades. I think at the time of recording this video, the longest loan you can take out within Australia is a 30-year loan. While offset bank accounts definitely reduce the profitability of a loan because you're obviously paying less interest for that loan, they also help maintain a healthy cash flow to reduce the risk of default of the bank. On top of this, while it might be obvious, it's still important to understand that banks generate revenue primarily through interest charges on the loan. The longer you keep your loan active with them, the more they profit. Now, as I mentioned earlier, I consider myself to be quite disciplined when it comes to managing finances in general. I am very strict with how I put money into my offset accounts, and I'm very strict with how I withdraw money from those accounts. I try my very best to never withdraw money from that account if I can avoid it. However, if a big expense came up, one that I really needed to make or one that I really wanted to make, let's say I wanted to purchase a new car and I didn't have the funds in my other accounts and decided to dip into this account and take money from it, I'm instantly prolonging the life of my loan because I have access to that liquid cash that I have now taken away from what its purpose was intentionally for. Not to mention that it would also take time to recuperate what might have been an impulse or even a calculated purchase. When you have access to funds, you logic with yourself that I can make this decision. Whereas in the olden days, you would just have to make extra payments to your loan and wouldn't have the ability to redraw or withdraw that money out, meaning you're contributing that money, saying goodbye to it. It's not something that you know you have at the back of your mind that you can spend any second you want to. So to sum it up, offsets work to prevent default for both the consumer, being someone like myself who has a loan, as well as the banks. But I'm not going to get into the technicals of that today. They also retain people as customers because they are advantageous to have for people like myself, sure, but it's a good way to build business and a model that brings people on or in as customers for the banks themselves. And they finally increase profits of banks themselves because loans stay active for longer as people have access to liquid funds and tend to spend relatively freely from them. In my experience, those who are very disciplined definitely get the most out of them, but I have not seen that as the norm for a really long time. They also are able to charge you fees often as part of a package to have offset bank accounts. I've seen some dodgy banks charge anywhere up to $10 per month per offset account. And I know people who have anywhere up to 10 offset accounts with a bank at any one time, which could be costing them hundreds, if not thousands, if not tens of thousands of dollars over the life of the loan, which at the end of the day might even mitigate the interest that they're saving on it. I'm not diving into any specific scenarios, just understand that they work both ways and the people who optimize them the best are the ones who will benefit the most from them, which is pretty obvious, but the banks at the end of the day are going to benefit the most. This is how I'm going to leave you today. Ultimately, understand that the financial products on offer are never for free. Banks will only ever try to make money from you. It's part of their business model, kind of is their entire business model. If the product exists, a bank is benefiting from it in some capacity, and you need to be smart and vigilant and optimize to make it work the best for you. There are benefits from all of the products they have on offer, and there are outcomes that will improve your quality of life Being able to borrow money to buy a house instead of having to rent, sure, it's a really fantastic thing in my opinion, and it's something that most people wouldn't have access to in today's day and age without the likes of things like offset bank accounts and many other elements that build into that world of home ownership. Just understand that again, without optimizing these financial products, you technically will be taken advantage of and can lose out big time over the course of a 30-year loan, as one very simple example. With that being said, today's piece was not specifically supposed to be tips and tricks. It was supposed to be an awareness piece about how financial products may seem amazing, but technically have caveats that make them seem, okay, I understand now why this product exists and why a bank might be offering it. Hope it was somewhat insightful. Hope you got something out of it. Be aware, be vigilant, be smart, and optimize your accounts to work best for you. With that being said, if you enjoyed today's video, hit that like and subscribe button. If you made it this far into the video, thank you very much for watching. And as always, I will see you in the next one. Bye for now.